Well, we've been inundated with analyst commentary since the Federal Reserve's hawkish pause. Some, like BCA Research, see the market rallying and the S&P hitting 4,500 by year-end. Meanwhile, Goldman Sachs says stock returns will be, quote, fat and flat thanks to rising rates. So where are we really headed and what does it mean for your portfolio? Well, thankfully, Yahoo Finance's Jared Blikre is here to break down some of that info. Hey, Jared.
Hey there. Fat and flat. I like that line by Goldman Sachs. They're thinking higher for longer with respect to the Federal Reserve. And so what does that mean? It means that stocks are valued too high right now. They can't justify jumping in long now. What do they need? They need to see either rate cuts or long-term earnings increase in the forecast thereof. However, once you start pricing in rate cuts, guess what? That means recession, because why would the Fed cut rates unless they're worried about recession? And so that's the circle we're operating in right now. As you said, Rochelle, all indices in the green right there. I just want to focus on the sector action. It's been pretty instructive, not only today, but over the last month. Today, we got communication services and discretionary materials all up about 1%. Over the last month, I've been talking about the rotation that we've seen into some other tech, into some other sectors besides tech, besides the mega caps, and that's indeed what we've seen. Consumer discretionary, that's XLY, that's up 8.5%, followed by industrials, materials, and real estate. And just getting back for a second to some of these Wall Street notes, also Morgan Stanley out, they're expecting a hike in July. Now that is not their baseline, that was not their base forecast a month ago. They thought it was going to be, we're over right now. That was as of the last FOMC meeting. However, they're saying that the Fed's hawkish tone, especially with Jerome Powell in front of the Senate and Congress last week, that kind of upped the ante a little bit on the hawkish stuff. And they're expecting, outside of very, very dovish reports from the payrolls that we're going to get and also CPI, outside of that, they think that the Fed hikes. So if we get a payroll below 100,000, or if we get a CPI print that's on a monthly basis above 0.2%, then they think that the Fed will have the reasons to pause. But just getting back to the earlier discussion of what happens when the Fed pauses, I just want to go back to the global financial crisis really quickly, because there's a very instructive example here. And in the meantime, I'm just going to pull up the VIX because I've been curious about that lately. But in 2004, the Fed had left rates at 1%, the very low for the time, and they started raising them. That was Ben Bernanke. He raised them into 2005, into 2006. In 2006, he paused for 12 months. Guess what? Stocks were making record highs that entire time. You contrast that with this cycle. We were in a bear market before the Fed even started hiking. So that's how quickly things are going right now. And it wasn't until the Fed actually cut rates in October of 2007 or thereabouts that we actually saw stock market finally decline. And that was the beginning of a huge bear market. Why? Because back to my original point, once you start pricing in rate cuts, that is an admission that you're going to get recession. So this whole thing is kind of, we're in a circular feedback loop right now. And some of it's defying expectations, defying reality, but eventually all these things come back to earth and valuations normalize and there's a return to the mean.